Good morning. Retired Employees Healthcare Benefits Trust, Wednesday, July 26, 2023, 7:30 a.m. All three members are in attendance. So next item, is there any public comment?
My name is Mark Antockley. I'm a Bloomfield Township Precinct Delegate, Precinct number 3. My public comment is on the water and sewer portion of the fund. According to Donnie Steele, based on our conversation after Monday's trustee meeting, using the water and sewer customers are only some of the customers that pay property taxes. You also have customers that are on well and septic. The payments that were required by water and sewer into OPEB were disproportionately damaging to water and sewer customers and placed an additional burden on them. I believe that's inappropriate. Hopefully, with the resignation of Treasurer Keeps, the new treasurer will look into this matter and rectify it. Thank you. This group is also supposed to look at actuaries. We were promised a presentation on the actuaries and why the consolidation of the subcategory funds and how the split of public safety out of the town fund was not unjust and unfair to public safety. We have a chance here, since Jason is here, would like to know why it's not on the agenda as promised by the Board of Trustees during the month of July. Thank you.
Thank you. We'll close public comment. Look for a motion to approve meeting minutes of April 26, 2023.
So moved.
Moved by Brian Keeps. Support by Michael Shostak. Those minutes are approved as submitted. Next item, we'll turn it over. We have Brian Green from ANCO Consulting to go over Quarter 2 2023 financial investment review for the retirement healthcare.
Great. Thank you, Jason. So I'll jump in just from a kind of an overall market commentary standpoint. As I'd mentioned, can't say I mentioned before because the meeting just started. You know, this has been the year where investors that did a victory lap for being conservative last year and going to cash, because remember last year there was nowhere to hide from a traditional asset standpoint. Stocks were in negative territory, fixed income was in negative territory. So investors that actually stayed in cash obviously lost ground from an inflationary standpoint, but their market value was higher at the end of the year than it was at the beginning of the year. Those that stayed in cash this year have been disappointed. We look, for example, for the S&P 500, halfway through the calendar year, it's looking at a 16.8% return. If we fast forward for today, that number is now north of 20, which is pretty staggering considering, we're only 7 months into the year. Mid-cap and small-cap stocks have fared well, but not as well, up 9 and 8 respectively. And international markets in positive territory as well so far for the year. Developed international markets, really led by Japan, are up north of 11. And emerging markets have languished a little bit. They're only up 4.9% and now pushing maybe 5.5% to 6% so far. So same story from an equity return standpoint from last year versus this year. Sharply negative last year, sharply positive this year. Fixed income, sharply negative last year as we dealt with continued rate hikes and continued increases in interest rates across really all parts of the curve. Fixed income is actually in positive territory so far for the year, really because of the amount of income that we're finally seeing being produced on fixed income portfolios. And I know we'll talk about probably cash results, but investors are pleased to open statements now and look at the yield on their money market fund and see something that starts with a 4 or 5, not something that starts with a decimal point and rounded to 0.01% that we've experienced for a number of years. So broad high quality U.S. fixed income actually up 2% so far for the year. Most of that obviously coming from clipping a 4% yield. But even high yield in positive territory and global fixed income in positive territory. From a sector standpoint, I always think this is interesting. I'll make this a little bit, last year, best performing sector was energy. Worst three performing sectors, again in a rising interest rate environment, were information technology, consumer discretionary, and communication services. The three best performing sectors so far this year are information technology, communication services, and consumer discretionary. We've gone from an arena and an environment of sharply rising interest rates, which are extremely punitive to growth-oriented companies, i.e. tech and consumer, particularly consumer discretionary, to a kind of flat, if not slightly declining interest rate environment, kind of neutral territory that's going to benefit names in tech, communication services, and consumer discretionary. Now, to be clear, most of that performance is driven by Apple, Meta, Amazon, the biggest names in the S&P 500. In fact, if you look, for example, the S&P is up 8.7% for the quarter. If you break that return down, the top 10 names in the S&P 500 comprise 28% of that index, and they were responsible for 2/3 of the return. So if you just owned the top 10 names in the S&P 500, nothing else, you would have been up 5.8% for the quarter, not 8.7%. So again, we're in this continued environment of really, really concentrated performance and really, really narrow leadership. Interesting to note, with Apple crossing, remember when we were all like, there's no way Apple can be worth more than $1 trillion. Well, Apple's now worth north of $3 trillion. And the market capitalization of Apple is worth more than than all 2,000 companies than the Russell 2000 index. So one stock in the S&P 500 is worth more than all 2,000 names that represent kind of the industry standard for the small cap part of the capital markets. So if we look, from an overall performance standpoint, one thing we've added, Michael, I think this was your request, and I think it was a great addition, is rolling up all of the portfolios into, an overall retiree healthcare. So positive returns for the quarter, positive returns in the last year. For the quarter, retiree healthcare up 3.17% versus the policy index that was up just over 3%. And in the last year, pushing a 9.8% return, again ahead of policy index, so continued positive trajectory across the board. Where did that come from? We saw strong performance from a number of different names, individual managers. And Cora, by example, 32 stocks in that portfolio versus 844 in their index. I'd mentioned technology was one of the best performing sectors. That was a big driver of returns for the Ancora portfolio. Names like Broadcom, Apple, Microsoft. They were also overweight JP Morgan. Continues to be an environment where those too big to fail banks have generated record profits. About 0.5% of the outperformance that Ancora had was just by being overweight JP Morgan. As I mentioned, S&P 500 up 8.7. No surprise there. Still that narrow leadership, right? 2/3 of that return came from 10 of the names in the portfolio. If we think about it a different way, 28% of that index drove 2/3 of the return. Edgewood struggled a little bit last year. We've seen a nice recovery. It was a great quarter for growth. You look at Edgewood up 11.1 versus their index up 12.8 versus Ancora's index only up 4%. So again, sharp reversal from what we saw last year where value led the way in a rising interest rate environment. Value is obviously going to have a heavier weighting towards banks and financials, difficult environment for them. Growth is obviously going to have more consumer discretionary and information technology. For Edgewood, stock selection in tech helped, but they were hurt by stock selection in consumer discretionary and consumer staples. Notably, didn't own Amazon, and they were overweight Estee Lauder, Illumina, and Nike. And Estee Lauder had a difficult quarter. It was interesting. We talked about NVIDIA in the first quarter was up pushing 100% return. I think it was like 90-something. They're up another 52% in the second quarter. So just a meteoric rise in that stock price. Clarkston outperformed. Given the strong market returns and how they're more conservatively positioned, I would have actually thought that they would have slightly underperformed for the quarter. So nice surprise there. They are lagging in the last year by about 3%. Longer term returns for them continue to be very, very strong. 21 names in that portfolio, helped by, and kind of a consistent theme here, Molson Coors, US Foods, so continued recovery from a consumer standpoint, and LPL. No surprise, they continue to be hurt by LTICE, now facing some issues with some fraud claims in their European division, have gone through a kind of a big shakeup from a management standpoint. Fidelity Extended Market, no surprise, up 6.4. Remember, this is the entire U.S. equity market, kick out the 500 names in the S&P 500 and own everything else. So there's actually just shy of 3,600 names in that benchmark. And it was led by some of the largest ones. And these are decent, like pretty big companies that from a profitability standpoint don't qualify to be in the S&P 500. But if they did, they would be a, kind of a 1% to 2% position. And it's common names from one quarter to the next. It's Uber, it's Palo Alto, it's Marvell, and it's Snowflake. So a lot from a technology standpoint. Looking at things from an international equity standpoint, slight outperformance from Oakmark. They've had a really, really nice recovery here in the last couple of years. On a trailing one-year basis, they're up 23% versus their benchmark up 17%. So 6% ahead of their benchmark, and almost 5% ahead in the last 3 years. For them, it's all been autos. Notably, BMW and Mercedes were two of the biggest drivers of excess performance for them, and Daimler Truck. From an emerging market standpoint, JP Morgan, bit of a growth bias to this portfolio, which we like from an emerging market standpoint, right? The play on emerging market is growth of the consumer, growth of the middle class, and that's going to play in a lot from a more growth-oriented name. 71 names in that portfolio, really driven by recovery in some of the biggest names, Taiwan Semiconductor, Samsung, and a big driver of their excess performance is they are significantly underweight China versus the index. So China is 31% of the emerging market benchmark, and we're talking China mainland, not Taiwan, not Singapore. Those are categorized differently. So the benchmark is 31%. They have 21% exposure, and that actually drove 1% of their outperformance. So if they'd been in line with China, they wouldn't have been up 3.2, they would have been up 2.2%. So big driver of outperformance for them being underweight China. And then finally, from a fixed income standpoint, we did see rates rise a little bit more during the quarter. Baird performed right in line with expectations, slightly ahead of the benchmark. And Brandywine, as U.S. dollar continued to weaken, some of their foreign currency exposure helped drive that outperformance. 1.4, almost 1.5% ahead of their benchmark. So all in all, good quarter. Saw the outperformance where we expected it to come from. That's the extent of prepared comments, but happy to answer any questions.
Can I have a question? Can you clarify for me the headings for the columns? So obviously quarter is the last quarter.
Yep.
Fiscal year to date is our fiscal year to date, so that's been March, so it's one quarter. So those are the same, okay?
Yep.
And the 1 year, is that 1 year from today or one year for the fiscal year? Like what?
So that would be the 1 year period ended June 30 of 23.
Okay. So that's, what I was looking at is that, so the columns on the previous page, your market update, you've got a 3-month, right, which is comparable. Mm-hmm. Year to date is not our fiscal year to date, that's our calendar year to date, right?
Correct.
And then you've got 1 year, and again, is that 1 year ended June 30th?
Yep.
Okay, so I can compare the 1 year column on that page to the 1 year column on the second page.
Exactly.
Okay, so our total combined portfolio returned 9.8% for the last 4 quarters, ended June 30th, whereas the market, the S&P 500, returned 19.5%. Am I reading that correct?
Correct.
Okay. And then the mid caps 14, the Russell's 2000. So I'm wondering why all of the indexes are so high and our overall portfolio return is not comparable.
It's because about 40% of the assets are in fixed income.
40% of the portfolio's assets are
correct.
Okay.
Yeah, unlike the DB portfolio, where what we talk about is 100% equities
Right.
and some real estate.
Yeah.
This, because it's the entirety of the retiree healthcare assets.
I got it.
Is a balanced portfolio.
Right. Okay. And then the 3 and the 5 year would also be 3 years ended June 30th, 5 years ended June 30th.
Correct.
Okay.
Yep. And
So the reason the returns of the portfolio are meaningfully less is because we're overweighted to fixed income because it's a more conservative approach to this portfolio.
Correct.
Okay.
And recall, and keep in mind when you look at those 3 and 5 year numbers, those are annualized. So, you know, let's call it 5.5% for the last 3 years is 5.5%, 5.5%, 5.5%. It's not over 3 years, $100 became 105. It's over 3 years, $100 would become
Right, 130.
17.
Yeah, okay. I got it.
Any other questions for Brian?
Do we need to revisit the asset allocation?
I would like to.
You would like to?
Yeah.
Okay.
Yep.
Do we need to make that an item for the next meeting, or?
Please.
By asset allocation, are you
Also,
going
like-
back to the 40%?
Yeah, 40% fixed income versus 60% equities. I assume 60% equities.
Correct.
Right, okay.
Brian, that's likely driven by the board's investment policy?
Yeah, but that investment policy is something that we have a tremendous amount of input into, and just have a conversation around, you know, the market environment that we sit in today is drastically different than where we were, you know, a year and a half, 2 years ago. Return expectations are much higher out of every part of the market except core real estate. That's really the only asset class that we've seen a decline in forward return expectations, and all of it's driven by, you know, Fed funds 2 years ago were 0, today it's 5. You know, so the building block in terms of where we start from return expectation is dramatically higher than where it was. I'm not even gonna say 2 years ago, I'm gonna say 18 months ago. And I think it's also just an intelligent conversation to have on a periodic basis. It could result in no changes, but it's great from an educational standpoint, it's great from a fiduciary standpoint to say, no, we looked at different options from a portfolio mix standpoint, and we made an adjustment, or we're comfortable with where we are based on the conversation that we had.
Anything else for Brian? All right, we'll move to set the next quarterly meeting, staying on the same schedule. Would be October 25th, 2023 at 7:30 a.m., followed by the FSC meeting. Any known conflicts at this time? Okay. Any new business? Okay, hearing none, I'll look for a motion to adjourn.
So moved.
Moved by Brian Keeps,
Support.
support by trustee Shostak. Thank you.
Thank you.